Welcome to the Explainer. Let's just be real for a second. If you've even glanced at the New Hampshire real estate market lately, you know it's incredibly fast-paced. Honestly, it can be a little terrifying. But today, our ultimate goal is to figure out exactly how to financially prepare for buying a home here. We're going to break down the math, the tools, and the exact steps you need to take so you can walk into your home buying journey with absolute confidence.
Okay, let's dive right into this. Whether you're eyeing a gorgeous historic property on the seacoast, or maybe you're looking for a little more space up in the North Country, you have to ask yourself a tough question. Does that dream home actually align with your financial reality? Because knowing your monthly costs is literally step one. Before you fall head over heels for a property, you have to know if the numbers make sense.
And when we talk about those numbers in New Hampshire, we absolutely have to talk about taxes. Now, as we all know, New Hampshire boasts no state income tax, which is fantastic for your wallet. But local property taxes, they range wildly. We're talking anywhere from 0.66% all the way up to 1.76%, depending entirely on the town or county. That is a massive variable that will dramatically impact your monthly budget. You really can't just guess these numbers.
Which leads us right into the current state of the market. We are seeing incredibly high demand paired with really low inventory, especially in popular, job-centric areas like Manchester and Nashua. In a market this competitive, moving fast is essential. Sellers are getting multiple offers, and if you hesitate because you're second-guessing your budget, you're going to lose out. It is absolutely critical to know exactly what your maximum offer can be before you even started looking. That way, you lock in a home without accidentally spending way too much.
Section 1. Decoding your mortgage costs.
Look, you aren't just paying back the money you borrowed, the principal. It's not that simple. Your monthly payment is actually a four-piece puzzle. It's made up of principal, interest, taxes, and insurance. When you look at the sticker price of a house, you're really only seeing a fraction of what you'll actually be paying.
To manage those extra costs, mortgages typically include something called an escrow account. Think of this as a special fund managed by your lender. They use it specifically to pay your local property taxes and your homeowner's insurance on your behalf. They just collect a little bit from you every single month, and then they pay those big bills when they're due. It really reinforces the fact that the initial price of the home is just the starting line of your long-term financial commitment.
And here is a huge point. A tiny, almost microscopic change in your interest rate can literally save or cost you thousands of dollars over the lifetime of your loan. Because interest is the core fee your bank charges for borrowing their money. Keeping a super close eye on rates is incredibly important. It's essentially the single biggest lever you have for keeping your long-term borrowing costs down.
Section 2. The power of digital tools.
Now, what's really interesting about this slide is the sheer contrast between doing this by hand versus using the right tech. Trying to calculate all these variables manually, it requires complex formulas, hours of effort, and frankly, a huge risk of a headache. A digital calculator, on the other hand, gives you instant results and high precision. It just completely removes the hassle of the math. Because there are so many variables at play, guessing your payment on the back of a napkin just won't cut it anymore.
And honestly, this is exactly why using a New Hampshire-specific mortgage calculator is an absolute must before you even think about putting in an offer. A generic nationwide calculator might not accurately factor in those highly variable local taxes we just talked about. A hyper-local tool provides instant, pinpoint-accurate insight into how property taxes and homeowners insurance actually impact your unique budget. It keeps you from overspending and gives you total confidence when you're ready to buy.
Section 3. Playing with the numbers.
And this brilliantly illustrates one of the biggest choices you'll make when you start playing with those numbers: your loan term. There is a massive difference in the total interest paid between a 15-year and a 30-year loan. A 15-year term drastically reduces the total amount of interest you end up paying the bank, saving you an absolute fortune long-term. But because you're paying the principal back in half the time, your monthly payments are going to be noticeably higher. A 30-year term gives you much more breathing room month to month, but it's going to cost you a lot more in interest by the end.
Next up, you can use the calculator to compare a fixed rate versus an adjustable rate mortgage, or ARM. A fixed rate mortgage keeps your interest rate totally constant, which offers great stability for long-term owners who just want predictable payments. An adjustable rate mortgage, though, offers a variable rate. It usually starts out lower, making it a really solid strategy if you plan to move in just a few years, but it can increase over time, so you trade off some of that long-term stability.
But the real magic happens when you start customizing your estimate. These are the powerful levers you can pull to prepare for literally anything. Try out different interest rates so you're braced for market shifts. See what happens if you bump up your down payment. It immediately lowers the amount you need to borrow and slashes your total interest. And crucially, don't forget to factor in private mortgage insurance, or PMI, if you're putting down less than 20%. By testing all these options, you keep your budget perfectly aligned, even if the market or your own finances change.
Section 4. Next steps. Getting pre-approved. Okay, we need to clarify a major point of confusion right here. So many people mix up pre-qualification and pre-approval, and they are definitely not the same thing. Pre-qualification is just a basic estimate. It's practically a casual conversation about your finances. Pre-approval, on the other hand, is a rigorous, thorough credit check and document review by a bank. Having a real pre-approval letter in your hand proves to sellers that your financing is totally secure. That makes your offer incredibly strong.
To get that actual pre-approval, you've got to show the lender the receipts. You'll need to prove your income with W-2 forms from the last 2 years, your federal tax returns, and recent pay stubs. Then, you'll need to prove your assets and your debts with statements from all your checking, savings, and investment accounts, plus the details on any existing loans, like student debt or car payments. Having all this stuff organized early on proves to the bank that you mean business.
So, to completely conquer this market, your strategy really just boils down to 3 focus steps. 1. Calculate your monthly budget risk-free using a New Hampshire-specific mortgage calculator. 2. Gather those essential financial documents so you are ready to move fast. And 3. Get pre-approved by a local lender. This journey moves seamlessly from the safety of a digital calculator straight to the closing table, making sure you stay in total control of your money the entire time.
Like, buying a home is one of the absolute biggest investments you're ever going to make. But by breaking down the costs, utilizing a state-specific digital calculator first, and organizing your documents early, you completely remove the stress and the guesswork. You've got the data, you've done the math, you have the tools. So the only real question left is, are you going to let the fast-paced New Hampshire market intimidate you, or are you going to use these numbers to confidently claim your dream home? Thanks so much for joining me for this explainer, and hey, happy house hunting!